I'd like to say thank you for everybody being here today, and we're going to dive into, how to capitalize on earnings season uncertainty and volatility, and some, kind of low risk option strategies. So again, thanks for being here. I like these Saturday events because the markets are closed. We can kick back and kind of focus on some things. Today, we're going to focus on earnings, which is right around the corner, and after a crazy couple of weeks, of uncertainty, now we've got even more uncertainty coming in the market with earnings. So we'll be kicking that off, and basically on the 11th when we have JP Morgan, the bank, start to report. So it's going to be a real nutty event. And so I'm glad you're here because I'm going to get you prepared and show you some ways that you can trade it. So a little background on myself. I've been actively trading, I guess, for 40 years. I have to pinch myself when I think about it, but started back in the 80s with a company called Coastal Corporation. It was a large integrated oil company with refining and trading. And so I was really fortunate, to get into they had a training program, and it was actually a training program to train you how to trade crude and oil products and things like that. So got my foot in the door there and was able to get that opportunity. And they sent me down to, first thing they did was send me down to a refinery they had in Corpus, Texas, a big refinery, and spent about three and a half months there. And it was just great because they just wanted you to learn just the basic fundamentals, oil coming in from a tanker, putting it into the distillation units, putting out all the products, and then see how that works. So you just get a really good feel for it. And then ended up in the shipping department, chartering tankers and scheduling, which was fantastic. And I finally got into the oil cargo side. Sent me straight out to Singapore, which was fantastic. Spent 2 years out there trading Asian crudes and products. And then I got a really great opportunity. I got a job at a company called Transworld Oil back in the mid 80s. At that time, they were the largest oil trading company in the world. It was Transworld, Fibro, and Mark Rich. And spent 17 years there, about 16 years in Bermuda, which is their corporate quarters and headquarters, and then ran the international trading group for 10 years. And that's where I started trading options. So once I did that, saw the options, the opportunities, and all the things that you could do, it just kind of never looked back. So a little background on myself, and again, appreciate everybody being here, and let's get rolling. So the following presentation is purely for educational purposes. Any stocks, futures, or options mentioned does not constitute advice and should not be construed as a recommendation. Now, have you noticed how earnings are horrendous and the stock goes up? Or we'll have earnings that you think are just fantastic and the stock tanks. Now, this is what I kind of call the earnings confusion. So, when a company has an earnings conference scheduled, many times there's going to be speculation not only into the accuracy of their projected earnings and the revenues, but other factors as well. It could be that they're coming out with a new chip, or they could be, they're going to lay off, 1,000 people. So you never know. That's what makes the uncertainty, going into an earnings release. You just see the implied volatility and the volatility in the anticipation of something happening, of uncertainty going into it, and then after the event, that's all taken out. But there's that big spike in volatility that heads into it. Now, this is typically this kind of uncertainty is what causes that increase in the volatility in your shares of the stock that's headed into their earnings release. And that's actually the big diamond in the rough. It's this temporary parabolic rise in the volatility when it spikes, the option price is higher. So, basically what happens is, again, traders, will tend to, human nature, sit on the sidelines going into the earnings release of the conference call. But then all of a sudden, you're going to say, okay, well, I'm a buyer. I've got all these stocks. Maybe I should start, reducing my risk. So I start swapping out the long shares. I still want to have exposure, but I start buying, options, call options, kind of replace those shares, to kind of reduce my risk, but still be there in case, the shares move higher. But I want to limit that potential risk. So you see that all that activity coming in on the buy side there. And then you see the same thing. You'll see additionally put buyers coming in, force the option prices higher as they try to protect their positions from any major downside movement. So it's all this concentrated option buy. In many cases, it drastically expands the levels of your stock volatility being, going into and traded into the earnings release. So as an individual trader, we can take advantage of all this uncertainty and volatility in order to capture those profits. So, start thinking about all the different stocks this earnings season, and think of the additional uncertainty we're going to have with all the kind of current, things that are happening now. The markets are really looking for earnings to see how the slowdown, all these things are going to affect that. And that's what drives the market. So this earnings season could be a really special one. So basically, no matter what the crazy earnings reactions are, if you know the right setup, we can trade with kind of basically non-directional. So we don't care if it goes up or down. So that's what I'm going to show you today. Some really great strategies that you can use to take advantage of, not having an idea of where the stock's going to go. So step one is you want to identify and qualify a particular stock by looking, want to look at its past performance, its history. You look at the probabilities of what it's done in the past to see if it kind of has a statistical probability of doing that kind of same reaction in the future, or in the present kind of earnings coming up. So then you want to find those stocks that have their earnings release also during a weekly option expiration. So when I'm doing a scan or a filter, looking for the stocks for earnings, I look at the weekly options. We don't want to trade a monthly option. Now, if it's a monthly option in the week of the earnings release, we can do that. But we want to take advantage of weekly options, and we'll go through why that is. Now, step two is we then want to evaluate, and this is a really big, important part. We really need, this is where I say this is your homework. We want to look at the past performance to see what volatility has done to that stock previously as it moves closer to its earnings release, after its earnings release, and then, post earnings, from there. So very important to kind of study to see what, if there's any kind of thing that similarities, consistency for that stock, what it does heading in its earnings release and then post earnings. So then that's going to prepare you, and that gets the traders prepared for these dramatic increases in that stock volatility. Now, typically, when you look at stock volatility, you'll normally see, depending on the beta, the volatility of the stock in general, it's going to be around 25 to 40%. But the week of earnings release and the day headed into that day before the release, the volatility can easily move to, very extremes. So you want to be recognizing that and understanding what you can do with it and what you shouldn't do with it. So this is what really makes a stock potentially a great profit opportunity. It's that volatility that normally will double, and sometimes it goes even more extreme to 3 times the normal volatility. So this is what we want to look for, and this is what is going to tell us what we can do. Now here's a kind of a really good example to illustrate volatility. So here's like NVIDIA, which everybody has been following lately, obviously. And so here was the earnings were going to be coming out on the 13th after the close. So this is a Thursday. So that these stocks typically have the same days every earnings season that they'll release. So earnings for NVIDIA is usually always Thursday after the close. So Thursday, but before the market closes, you can see NVIDIA had an implied volatility here on this option series. This is the weekly series for when it's going to be released, of over 114% implied volatility. Now, you can see normally NVIDIA is around 35 to 40%, right? So it's like 3 times the normal volatility. So then the day after, it's trading here at 270.78, and then expiration is going to be the next day. So the next day, let's take a look and see what happens. So the next day, you've got NVIDIA has what we call the volatility crush. That vol went from 114, and now it's 35. It's back to normal. All right, so that volatility just crushed or collapsed. And also, not only did the price change, the price going into earnings was 270, but now the day after, it's 7.5% higher at 291. So one, we had the volatility collapse. 2, we had a huge spike in price. So really a lot of things that we can do with these kind of conditions. Now, so the day after earnings, and so here's kind of the chart to kind of see it more graphically. You can see here's where it was, 270. Here's the implied volatility. You can see it just, trending up. And then, after the earnings release, that is a volatility collapse, what we call a volatility collapse. And then our vol crush, and then you can see the price also spiked up to 7.5%. So there are a couple things that we can do here to take advantage of the price spike or the implied volatility collapse. And that's what, I'm going to go over here today. So, for this reason, it's essential to have a watch list of your stocks that you can monitor closely due to the fact that they're not going to all present an equal kind of opportunity. So some stocks are going to have what I'm looking for is consistency. Some stocks are going to be consistent as far as they either go up or down real hard, or they have this great vol collapse. But then there are other stocks that are just inconsistent. One season they go up hard, another season they do nothing. So we want to look for kind of consistency, and that's what's going to make that equal opportunity. Now the goal is to take advantage of this temporary rise in the volatility, as well as the past earnings performance, to kind of give a really good high probability list of stocks that we can look at for trades. So there are three types of earnings cycle trades that we will look for. So first off, there's the kind of cycle trade where there's a trade that you can do where the stock is trending into its earnings release. So we'll look at that. And then the next one, this is a big one. This is the one that we're going to typically really focus on here today. This is the earnings release trade. So this is basically a non-directional trade where you don't care if it goes up or down. You're just going to either play volatility collapse or vol spike or vol collapse, basically, or price spike. Okay, so this is the one we're going to really focus on here today. And then the other one we're going to look at, and I'm going to show you, is a trend trade post earnings. So a lot of times you'll get a great post earnings trend from the stock after it reports its earnings. So it could be a fantastic earnings and it keeps trending up, or it could be horrible earnings and it keeps trending down. So I'm going to show you a way that you can take advantage of that with a kind of a non-directional exposure to the market. All right, so these are the three trades. So here's just an example. And so this was CRM, and it actually had all three of these types of trades that were available. So number one is the trend trade into the earnings release. Now what happens here, again, think of the uncertainty. As you get closer and closer and closer, here's your earnings date right there. All right, so the market's moving up. CRM actually has a trend. The price is trending up. You can see nice trend now. A lot of times when we're in a normal kind of a bullish market, which we're now in a lot of uncertainty, typically like in 2023, 24, was pretty much an uptrend. So CRM was trending up, and that's typical of what happens with the stock, because typically, when you're in a decent market, the markets are looking for those earnings to expand. So, the market players are getting in a week, 2 weeks ahead, in expectation that the earnings are going to be good. So the price is going up, but also the volatility, implied volatility here, which is that teal color, is also going up because the market still doesn't know what's going to happen, the uncertainty. So there's a lot of buying coming in, the implied volatility is going up because of the uncertainty. So this is a trade that you can do where, one, you would buy the options in this earnings release series. Okay, so what happens is, number one is the implied volatility is going to go up in this series, right? So that's going to go up, and that's going to increase. That's going to increase your option price. Volatility goes up, option values go up. And two, you're getting this trend to the upside. So if you were to buy calls in this series, let's say you buy a call here and it costs you maybe $100. Now, one, you're going to get the delta, it's going to go higher there, so that's going to go up. But also your implied volatility is going to go up, so that even makes that value of that option go up even more. So it's a great pre-earnings trade. Now, the next trade is the trade 2 that you can get, and that's when you get right there to the day of your earnings. And this is where, when you're doing that trend trade 1, you want to be out of that trade. That's a trade. Exit the trade, take profit, get out, and then the next trade you have is the earnings release trade. So this is what we're going to really focus on here today. So this is where your implied volatility has really been pushed out to abnormal levels, so, either 2 or 3 times the normal level, right? So you've got this big implied volatility here, and then the earnings are released, and then what happens? Boom, the uncertainty's out. It just like popping a balloon. Volatility collapse, crush, right? So there's an earnings type, non-earnings trade release that we can play there to take advantage of that crush. Or the other thing is the price after the earnings release a lot of times can have these big spikes up or down. So we can play that with a kind of a really defined risk type trade. Now that's the second type trade. So that's totally a non-directional trade, which I'll show you how to do. Now the next one is your post-earnings trend trade, and that's where then the market, settles down, and figures it out and says, oh, okay, wow, this is good. That was good earnings in CRM. So let's trend higher. So you've got that trade, and there's a number of different ways we can trade that as well. So here's an example. For example, here's Nike. And its earnings are going into the earnings that are going to be on the 20th of December. So it was trading at 161 right down here. And then you can see it just keeps trending. The price is trending higher. And also you can see implied volatility is trending higher. Well, let me start here. Okay, so that is a trend right here. And actually here you can see price is trending lower on Nike, but the implied volatility is trending higher. So that's your typical situation. You can have price trending up, into earnings, and implied volatility is moving up. In this case, price is trending down, but implied volatility is going up. The earnings are released, and boom, you have a collapse. In this example, though, you had a spike in price. So here's another one. You can see it trending down into earnings right here. And look at the implied volatility. It was trending up, and then it collapsed. So that's the norm when you head into an earnings. All right, then step 3 is what I use is an pre-earnings checklist to kind of systematize the process, which is important for making the best trade selection. So in trading, the more systematic you can make whatever you're trading or the process you're using, make it a kind of a systematic way. That's going to take your emotions out of the trading, and you want to make it more mechanical, doing the same thing over and over and over again. So, you do take your emotions out, and you make the right steps each and every time. You don't mess up, you do the same process each and every time. So very, very on the checklist, what I'm looking for here is must have options, but must have weekly options. I should put that in there. And it must have good liquidity. We want options with good liquidity. And there's so many that we can play, lots of liquidity. And then they must have high pre-earnings volatility. So we're going to actually look at 2 different types of ways we can trade. One is really high implied volatility. Others are where we're looking at stocks a little bit less, but still have that volatility spike and then the crush, okay? So then what we're going to do is, I put together kind of my watch list of these various types of stocks I'm looking for. And I put together 3 type of lists, or you call it buckets, of the different potential earnings type trades. One is looking for those stocks that have moves of greater than 6%, either up or down. Doesn't matter if they go up or down, but want to make a list of stocks, past stock earnings that have that tendency to spike either up 6%, greater than that. 6% I don't want, but that's my cutoff. I want greater than 6% up or down. Now the other list that I put together is for those stocks that have not huge movements, but have consistent pattern of movements of not more than like 7%. Okay, so we have a cap. So they tend to have a tendency to stay in kind of this range between 7% up or 7% down. So these are stocks that don't really have those big spikes. We don't want the huge spikes, because in this kind of situation, I'll show you, this is where we're going to play a really great strategy, what I call the double lightning. All right, so that's what I really look for there. Plus, the other thing that we're looking for is when we do trades looking for volatility collapse or crush, we want to select those stocks that don't have huge spikes, because if we have a trade strategy where when you short options, either calls or puts, that's shorting volatility, okay? So when volatility is really high, traders want to take advantage of that abnormal spike in volatility and they want to sell it, right? So that's to sell volatility, you actually are selling either calls or selling put to take advantage of that. Now think about it. So if you had a major price spike and you were short your calls here or price spike below and short puts, you're going to get crushed, right? So we want to really have a defined list of stocks we're looking for to put in this bucket. So very important. That's the big part of your selection process and your homework is to select the right stocks. All right. So then we want to the next thing we're going to do, and these are things that just happen. Boom, boom, boom. These are fast once you get the screen going and everything. So then we want to calculate the implied stock move the day of its earnings release. So we want to get an idea of, it's a movement up or down based on the, based on the market theoretical probabilities. And then we'll perform our target analysis based on this implied move. And then that will then help us to select the appropriate weekly option strategy based on, how far up or down this particular stock may be. Is it one that spikes hard, or is it one that's contained, or is it one that spikes hard? So we want to make that bucket list, put those together, put together our plan, our action plan, our entry plan, our exit plan, and then our exit plan. All right, so we're going to then be totally prepared for what we're doing. We're not just taking a flyer. We're not just taking a guess. We're taking a really high probability trades. So here's an example of some of the kind of the analysis that I like to do. Here's like, for example, Roku. Now, before I get into this, I will actually be doing next weekend a in-depth course on this. Today is a kind of a overview of everything, but then next Saturday is where we're going to get into all the nitty-gritty. And so this will be next Saturday, the 5th of April. The course will start at 11 a.m. Eastern till 2 p.m. or however long we need. And then we'll follow up on Monday the 7th from 4 to 5 p.m. Now, let me give you the link, and I'll just kind of briefly go over this, and then we'll get back into all the details here today. But here's the link that I want you to use if you'd like to take advantage of the discount I'm offering on this course. It's a fantastic earnings course, and it's yours to keep forever. Once you buy it here, it's yours. So use this link here. And once you put that link in, click on it or copy and paste it. And then what you're going to have is you're going to have a payment link pop up. Let me show you what that looks like here. And so this payment link will pop up here. All right. And then what you're going to do here is, it's a real easy way to sign up for the course, but you're going to get a 15% discount on the course today if you sign up. So here's kind of all the details of the course package. I've got two packages. Package one is the course with the, some additional things I'm going to throw into you for the bonuses. And so this is, going to be $197, but for today with your discount, it'll be $167. So what you're going to want to put in is also in small cap, just put in EAR earn 15. Okay, and then put that in as your promo code. Well, I'll show you that in a second. All right, and then that'll give you the discount of 15% off. So you can see here, just a quick summary of what you're going to get in addition to the course. But you're going to get the 4+ hour course, which will start next weekend, and that's $1,600. That'll be once I go into next week and offer the course out. It's going to be $197. But today with your discount code, it's $167. So you're getting this at 89% off. Now you're going to also get right away my on-demand course that I did recently. So this is a 4+ hour. I think this actually turned out to be a 7-hour course. We had so much going on. But on my website, this is $297. So you're going to get that right away, so you can get cranked up and learning before even Saturday. And then you're going to get bonus 2. You're going to get my Start Trading Options today. This is an option course teaching you a little bit, kind of an intermediate to kind of the fundamentals of options and some really good option strategies that you can learn. That's $197 on my website. And then you're going to get a 30-day trial membership to my trading club, so you can start this whenever you want. Then we'll do a follow-up Q&A, and that's value $300. And then you're going to get my option Greeks. So this will be a handout that will show you how the Greeks work, theta, gamma, things like that. And then I'm going to give you my 3 best, my stock list of these earnings. These will be the buckets like I showed you earlier, these trades that you're going to look for, 3 different types that we're going to look for. So you'll get that. So the total, course bonus value is there, but the total course value with all the bonuses is over $2,600. And if you sign up today, it's under 67. So that's like $4 a day. It's a great deal for you. You're going to learn a lot. And again, this is a course that will be yours to keep. So basically you get 93% off there. You'll get the recording of the course, all the handouts and the PowerPoint. So you just click on that buy link right there. And then come down here and you put in, you can see it's 197. Now, also, if you do want my indicators, you can add those. This is my indicators that today I'll show you a couple of those, but they're fantastic. I've got these from Thinkorswim, TradeStation, eSignal. So just put in that promo code EARN15, click apply, 167, you've got that. Now, the second package, and I'll just kind of briefly go over this. The difference here is this will be, you're going to get this course package 1, everything in it. But if you want my alert service, where I send out all my alert trades, you can add that to this offering. So this is course package 2. So with this one, you're going to get everything that I showed you in course package 1, the course, all the bonuses, but you're going to also get my alert service where I send out 5 different type of trade alerts. So you'll get this for 4 months, plus you're going to get 4 months to my trading club. So this gives you access to my virtual trading room, our Q&As, my weekly, daily video updates, our trading educational vault, and discounts on everything on my website of 60% off. So everything in course package 1, plus all 5 of my alerts for the next 5 months. You can start and stop when you want, so you don't lose your time. Quick summary of our results. I started my first part of the alerts back in 2018. So this thing has been going on for 5, 6, 7 years. Wow, long time. And I've had of the alerts, now I've got the 4 different types of alerts, which let me show you the different ones that I send out real quick. So you're going to get, basically I send out either breakout reversal type trades, which could be credit spreads, or I may send out a selective calendar diagonal, or we do a lot of those, or a butterfly or long condor. That's a lot of things we do. Or during earnings season, I send out very selective earnings trades. So you'll get those. And plus we do a lot of really cool butterfly pinning type trades or calendars. So there are 5 different types that I send out. And so that's what you get. These are the results there. So with these 5 different strategies that I send out, we've had 847 trades closed out, 609 winning trades, 58 break even, 180 losers, running at a 79% win rate unaudited. So that's pretty darn good going back to 2018. And I'm very, very selective and just very, very conscientious about the trades I send. So that's what you'll get. You'll get for 4 months plus the trading club. It'll be $597 after today, after when I go out next week. And here's some other things which we'll go through later. But if you want to add this to the cart, and just come down here, click package 2. It's $597. But if you put in if you put in the promo code EARN15, you will get this for $507. And there's also a 2-pay if you would like that. So you can do a 2-pay plus. Again, if you want my indicators, you can add that to your cart. Okay, so if there's any questions, be glad to answer those at the end of the, towards the end here. We'll go back more over this. But again, just a quick summary. So this will start next Saturday, the 5th, 11 a.m. Eastern to 2 or however long. It'll all be recorded as well. and then broken down in modules. So, you know, if you do miss parts of it or you want to go back, obviously this, again, it's yours, you know, from on. This will be, you know, you'll have a special login place where you can do, you know, capture your course, and then we'll finish up Monday. So again, it's 197. Today it'll be 167. Use that promo code EARN15. Use this special link here. And then if you have more questions at the end of towards the end here, I'll go back in detail over everything there and answer questions. Plus we'll do a Q&A at the end here as well, so to answer any of your questions you may have. All right, so that's coming up. And then let's get back into the earnings. One last thing, sometimes you may have purchased other courses, and if you're like thinking, well, did I always purchase this in the past? What you're going to do here is, if this is an all new course, so you just can go back into your personal account tab, and then you can pull that up and you'll see everything that any courses or indicators will be listed for you. And if you bought this in the past, you'll see on your account tab, you'll see this earnings. All right, so that'll tell you if you bought it. So if you don't see that, then you don't have it. All right, and so this is, again, it's a new course. You know, I'll do this, you know, every quarter typically, but they're always changing, and there's always different things that we're going to, you know, cover based on what's going on in the market. So here's just another example. Then Roku, you can see one day before its earnings. It also has earnings on a Thursday after the close. So look at the implied volatility here. It spiked up. Normally, this is a high volatility stock, but it spiked up to 212. So this is over 3 times the normal implied volatility. And right here, it's showing you that it is the expected move. It could go up $16. So that's one day. So the market is implying huge potential movement for NVIDIA, and this is what we can take advantage of. So NVIDIA trading, you know, here like 137, and what it's telling you is that the implied volatility, this thing could spike up $16. So it could be up $16 the next day higher, or it might be $16 lower. And that's just one standard deviation. All right. So you can see here that that's a normal, that's 3 times the normal implied volatility, but that's like a 1 standard deviation based on that, but it could be 2 or 3 times that. It could be actually, you know, this could be 2 times, it could be 20, it could be 32. So these things can be just crazy. In this earnings season, I think we're going to see a lot of these unbelievable moves, you know, up or down, either way. Okay, so then you can see the next day, this is the vol collapse here. Now it's back, you know, going back to kind of the norm, but also not only did the volatility collapse, but you can see the price was trading at 137 before the earnings were released, and then the next day they were trading down at 127, 7% lower, right? So sometimes we see, you know, it could be 21% lower, it could be 20% higher. So you want to select the right stocks. You know, it's very important. All right, so that's Roku, and then you can see, you know, my analysis. This you can see here. Just these are, you know, some of the stats I'll look at. So this is the implied move history. So you can see Roku has had a tendency for big implied moves. You know, 10, 11, 14, 14. Now this is based on the straddle price, which I'll teach you in the course how to do this. So that's how the implied move, and I'll teach in the course how to figure this out with the straddle price, you know, and then what it means and how to take advantage of it. And then the next thing, the most important thing, then I look to see, well, what did it actually do after its earnings release at expiration on expiration. So with Roku having its earnings release on Thursday, then the next day was expiration. So you can see, you know, it was in this series, you can see it tends to have big moves. So here it was basically 7% down, 8% down, 6% down, 16% down, 20 up, 28 up, 25. So big, huge moves. So what I want to do then, that's consistent pattern. And then here's the smallest move. I'll look for that. Okay, 6%. So we can, you know, there's something we can do based on what we're seeing here. So this is our guidelines, what we can then look at to figure out, okay, yeah, there's a good trade waiting on us here. This is a potential for big, huge price moves. How can we take advantage of it? And then I'll show you here in a minute how we can do that. Now then, here's just a more, kind of organizing the statistics so you can see it. You can see Roku going back over 8 cycles. Here are the prices, etc. But you can see the implied move based on the straddle cost here going into the earnings release. You can see it's all lined up here, 10%, 12, 14. This is either up or down. But on average, then over these 8 cycles, the implied move, based on straddle price, is a potential of 14.5% up or down. But then when you look, well, then what did it actually do at expiration? It actually exceeded what the market thought it was going to do. So that gives us a really great idea of the type of trade. And then we look at where it was. You can see here it was down about 7, down about 8, down 6, down 16, etc. But here was the smallest move. So with this, we can kind of get an idea of what's the lowest or worst case scenario, and then we can see what the extreme is for the move up or down, and we can play off of that kind of 6%. And then, so think about this: if you had done a trade, I'll show you in a minute, for a big price spike move up or down, at a minimum of it had to move either 6% up or down at the expiration. This is a 100% winning probability type trade setup with a certain strategy that we'll touch on here in a minute. All right, so that's your homework. That's what you have to analyze. It's really important when you do these earnings trades to do this analysis. Step 4 is the power of weekly options, which we're going to use. Now, I like to use weeklies, and then the advantage of the weeklies is we're going to take advantage of the time value and the implied volatility. So 2 things basically, when you're valuing option, the 2 main components are going to be time value and implied volatility. Now, as you know, when we're going into the uncertainty of an earnings release, what happens? Implied volatility goes up. And then what happens at expiration or after the earnings release? Volatility collapses and goes down. And then what happens to time when we get to expiration? Time goes to 0. So it goes down. All right. So we're taking advantage of both time and volatility. All right. So these are basically the 2 pricing components and that really price out the value of an option in general. We're going to take advantage of that. So when used correctly, this can help us to create low cost, very defined risk, kind of a trading formula to go by to generate some really great returns in a very short period of time. And so the duration of these trades could be 1 day to 3 days. This is kind of the longest duration on a trade typically would be 3 to 3 days. Now I'm going to show you another strategy, the double lightning, though, where we can get a post-earnings trend off of it as well. But this is kind of what I call that lightning in the bottle, because you can get some really great trades and profits in a 1 day period. And that's another thing too. When you're in an earnings season, a lot of times you're caught sitting on your hands because you don't know what to do because of the volatility where the stock could either spike up or spike down. You have no idea what to do. So you're just like on the sidelines, chomping at the bit to do something. But with these strategies today that I'll cover, it gives you a chance to get some great returns, get in the market, and it's some of them are exactly like lightning in a bottle. You just want to bottle it up and do it every time. So if you know then what weekly option strategy to use for your earnings trade, how to construct the trade, and then when to trade it, then these weeklies can really give you some exceptional fast profits due to the leverage they offer you. And they're going to provide you a perfect vehicle for trading an earnings on a stock with the earnings coming up. Now, the next thing is then, what do? How do you pick the right strategy? And this is where I call my kind of comparative option strategy analysis. So what we want to do is we're going to look when constructing the earnings trade, we're going to look we look at the risk to reward and the return on the capital that you're putting up for risk. So this is what we do on any trade or any investment you make. You look at the risk reward, right? So, but on these earnings trades, it's really important. And on any option trade, obviously, we want to see what is our risk and then what is our reward based on that risk. I always look at the risk first. And so that's your return on your capital that you put up at risk. So what we're going to do then is look at that based on the various strategies that we could use, option strategy to use. And then that's going to give us, okay, the best selection of what we're looking for as a trader. So it could be, Tom has a trading account of 100,000 or 200,000, whereas, maybe Wayne, has 5 or 10. So it's going to make a difference of your risk reward component of your trading style, and also how much risk do you accept. Okay, so that's a really important part. So, but this is where we can compare and make that analysis. And then 5, okay, I got all this other stuff, but what are the strategies and how do they work? So there are kind of 5 basic option strategies that I use to capture, profits from the extreme volatility that surrounds every earnings season, and also profits from the big price spikes up or down that can happen to selective stocks. All right, that's the opportunity. Now, the different strategies, the different 5 strategies are, first is what we call the short iron condor spread. Okay, so this is basically actually a debit spread. And this is an option strategy used for the big price spikes. So when we get those explosive moves up or down, we don't know which way, but they're big. And this strategy takes advantage of that. The other second one is the long iron condor spread. Now, this is a strategy that you're going to use. It's a credit spread for the volatility crush, all right? And volatility crush or collapse, how do we take advantage of it? We sell volatility. To sell volatility, we sell either calls or we sell the put. We're selling, okay? That's selling volatility and selling time. The next one is what we call the long iron condor butterfly spread. It's also a credit spread used for volatility crush, collapse, volatility crush, okay? Selling vol. And then the fourth one is a really cool strategy that I put together called what I call the double lightning. All right, so really cool strategy. This is what I call a flexibility trade as well, because we're going to take advantage of the vol crush, but we're also going to be able to ride a post-earnings trend with it. So, but it's actually a debit spread, so that's your risk is your debit paid. So it takes advantage of vol crush plus post-earnings trend. So very cool trade. And then the fifth one is a fantastic way to play a post-trend trade where you're market neutral. So it doesn't matter if the markets are going up or down, you're playing a post-earnings pairs trade on the relative strength, of a specific stock relative to something that it correlates with. So it's a long-short strategy, what we call a pairs trade or pairs or spread trade. So these are the 5 types of trades that you can do, the buckets that you can do as far as the trades. And then what we're going to look for with our scan is we're going to look for those specific kind of stocks that would fall into this kind of bucket, right? So these are going to each be different strategies, and certain stocks are going to be the best use would be based on this strategy. So we've got to pair the stock with the right strategy, or if that stock sometimes may be one that doesn't work for any of them, okay? Those are what I call totally inconsistent, where they have no rhyme or reason, so you're gonna run across those. All right, so first let's look at the vol crush. So this is a long iron condor credit spread. Let me check the question here. Are there any earning trades that don't involve selling an option? Yes, I'm gonna show you that. Yeah, I'll show you that. Good question. So there's another thing too you want to think about. When you're selling, when you say selling an option, when we do spreads, we are also selling options, okay? So just keep that in mind. So, you might be long a call, but then you short a call, right? So you're selling an option there. You put those two together, you've got a spread. So you can do that in your IRA, right? So that's when you can do an IRA. or you might sell a call, but then to cap the risk there, you're buying a call above it, right? So that's a credit spread. So a lot of times you might be able to do that in your IRA, and that's selling volatility as well. All right. So as a spread, depending on your IRA account, your broker, you should be able to do things like that. But here's one that we do for a volatility course. It's called the long earned condor credit spread. So it's a defined risk. But it's a non-directional earnings release strategy. So this is where we have no idea if the stock's going to go up or down, but we do know the volatility is extreme, and we want to take advantage. We want to sell it, right, for that collapse. All right. So I do a screen. And I've got another, screen that I do where I'm looking for, very selective stocks I put into this kind of strategy I'm looking for. So it increases the trade winning probability. I'll show you what that is. Now, then this takes advantage of the pre-earnings high implied volatility, right? It goes up. And then we're selling time and volatility. That's the whole thing. We're selling time, volatility collapses, crushes. We're selling time. Well, the time goes down into expiration. These are short duration, okay? And then volatility, crush, right? So those are two things we're getting advantage of, profits from that. Now these trades are either 1 to 3 days max, okay? Very short duration trade. Okay. All right, so yeah, I'm gonna, okay, well, you'll have to see then, try to check it out with these trays that I'm showing you. All right, hold on one second. Miss anything? Hold on one second. Yeah, well, if you can't make it next Saturday, it's all recorded. And so you're going to get everything, the great thing. If you want the course, you can go on my website and, just answer one question. A person may have to work, but if you go on my website, you can buy this course, but it's $397. But if you do it today, it's $167 plus it's an all new course, we're going to be looking at what's currently going on, right? And giving you some stocks and how to trade those things that are currently going on. So, it's all recorded. So you're going to get it today for $167, but you're going to also get all the different additional add-on bonuses that, that you would not get if you did go to the site and get this course. And this course on the site is on demand. It's not current. Okay. So this is a big plus for you. If you can't make it, it's still a great value for you just to buy it as the recorded course. Plus, then you can come to the trading room. You get a 30-day free trial. You can come in there. You can come to our Q&As, etc. All right. So hopefully that answers your question there. Fibonacci, yeah, I'll be doing a course on Fibonacci very soon. All right, so here's an example. Now this is one on JP Morgan, and this is one I like to do with JP Morgan because it kind of fits in this bucket where it doesn't have these huge moves. It's very consistent. So here's the history, the implied expected move history based on the straddle cost over time. So here's just going back 4 cycles. You can see it's not a huge mover, about 3.4%, about 3% up or down, just not a high beta stock. So for this one, it's a certain bucket and a certain way to trade it. And it's going to be it's going to be, this iron condor credit spread. So you can see here, this is a really great way that I like to look for. So here you can see it had a big move down. And then what happened the next, this is what it actually did then at expiration, okay? So you can see not big moves, about 3%, but then on the day of expiration here it was down 1.2. Now the cycle before though, it had hit real hard. But then what happened the cycle after? It normalized. Here it hit real hard to the upside. What happened the next one? It normalized. So this is a great one where you see that one is exceptionally good. But this is a good one overall. This is to sell volatility and time. and the vol crush, okay? So you can see here going into it, here it is, JP Morgan into the day before the earnings. Now, this will, the JP Morgan does the in the morning, so this would be like a Friday morning would be when they release it. So this trade we set up on a Thursday before the close. So you can see here 1 day to expiration. This is on a Thursday, expiration the next day. You can see the volatility on this series is up to 73% implied vol. So, but normal JP Morgan, look here, it's like 20, 25. So still a big spike in volatility, right? So 2 or 3 times the norm. And so like here it could be up $6 up or down the next day from that 207. So it's a big volatility spike, not normal. So that could put, it could be up $6 or it could be down $6. So we're going to take advantage of that by selling volatility on this one. And then you can see the next day it's trading from 207. Now it's trading at 204. Look what happened to volatility. Boom, collapsed back to the norm. So let's take advantage of that. All right, so here's how we're going to do it. So here's JP Morgan. Here's the chart, what it looked like going in. So you can visualize what's going to happen. Here it is on the 11th, the day before the earnings were released, trading at 207.57. And then here it is the next day at expiration, it's trading at 205.93, down not much of movement, 0.79%. So it's just pretty flat. This is perfect for selling vol. So here it was, implied volatility, it spiked up. It doesn't look like much, but it had. And then look, it just goes straight down, but it didn't move. Perfect. This is exactly what we want. So here's the trade setup. So we did an iron condor credit spread where we were selling volatility. So we set up the expected move. The market was telling us, look, to expect this thing to be up 3.12% up or down the next day. That would be 1 standard deviation the next day. But looking back, doing our homework over 5 cycles, over past 5 earnings cycles, the movement's been about 3.36%. So not just pretty much in line, right? So we sold volatility. And so we were looking for that volatility to stay, under 4%. So we did this spread where we're going to be short. I'll show you the 217.5, long the 220, and then short the bull put credit spread 200, 197.5. We set the trade up for a credit of 45 cents or $45. So that's our potential profit, is that premium we receive from selling volatility. So these are basically probability trades for selling volatility. Now, this is a 22% return in a 1-day period. And this was set up based on the selection process that JP Morgan is a high probability stock to stay within its range. And so we could sell volatility. All right, so here's kind of looking at the delta that we did. We sold that 217.5 short strike on the call. That was 11 delta. So very, very low probability that JP Morgan will be at 217.5 at the close. Very low probability based on the delta. We look at that. I'll show you how that works in the course. And we sold short the 200 strike here with a 16 delta. All right, so again, kind of a low probability there. So here is the trade. So these are probability trades based on those statistics. And so we did the credit spread here. So we are basically, again, short the 217.5 call right there, long the 210. So it's a spread. So we're not naked short, but we're selling volatility. And then we're short the bull put credit spread here, the 200, 197.5 here. So we're protected, capped, selling volatility there. For doing that, we brought in a total of $45, 23 bucks on the call credit spread, 22 here. And so we had a max profit, went out right here, boom. We keep all the premium, volatility goes to 0 right there. We keep the premium. So that's your typical credit spread. Now we could narrow it in, increase our potential dollar received, but that also increases the potential risk that maybe it goes through that short strike. So it's a really balance of how you do it. And in the course, I'll show you how this is done and how you assess it. Okay. So that's one. And then now this is the next one. This is one that that I love to do for the big price spikes. And so this is what we call the iron condor debit spread. So this is totally different from that short, iron condor, short iron condor, where we're doing it for the premium and volatility crush. This is one we're going to do that's totally protected for a spike either up or down. So the iron condor debit spread, I call this the debit spread, so you know the difference. Again, defined risk, but it's a debit spread, not a credit spread, and it's also going to be non-directional. We don't care what way the stock goes after the earnings, we just need it to move. And so it takes advantage of that earnings release price spike, and it profits from the explosive price spike. So like short duration, 1 to 3 days max on this as well. All right, so that's a look there. This the iron condor. Now here's just kind of another thing to look at. So here's your iron condor credit spread. So here's what that looks like. Okay, so this one that I'm showing you here is what we call the iron condor debit spread. So it looks like this. Now, when when you're quoting a spread, the wings are how you assess if it's long or short. So with this one, the iron condor credit spread, you're short here, the body, and you're long the wings. So the wing is here, right? That's what the wing, they call that the wing. So they would call this a long iron condor or a long iron condor credit spread. Now, intuitively, I would say it would be a short iron condor. That's the way I would think, but the brokers, they screw it all up. So they call that the long iron condor credit spread. And this they call the short iron condor credit spread because you're, let's see here, you're short here and long the body here, okay? So, so that's the difference there, okay? So just to show you, but that's what it's gonna look like. You're long here, the call, and you're short the wing, okay? So totally different animal, upside down it looks like, right? Well, it is. All right, just to show you, that's the risk profile. And we'll go through how, so here's a really great example on Tesla. And Tesla tends to have the consistency for big mover. So we can look at the implied move history based on the straddle price. And you can see Tesla has tendency to move 8 to 9% or greater. Just, looking at that real quick. But then we look at, well, what did it actually do at expiration? So, the earnings are released on Tesla typically on a Wednesday after the close. So you can see 3 days later, here's, what it's done. Here's an example. So here's up 26%, down about 11, up 16, down almost 12, down 12, down 10. So what are you seeing here? This thing has a tendency to have big moves, right? Big moves. So we look at the history, straddle, we look at then what it actually did, and then we can formulate what do we want to do? What bucket do we put this one in? And is it consistent? It is consistent. So what bucket do we put it in? All right, I'll show you. So then you look at just, you lay out the data and you can see over the last 5 cycles, see where it was trading here. You can see what the implied move history, straddle price history was. Tendency just, the market says it's going to theoretically go up 9% or down 9, you see it's kind of around 9, so average of 8.36% up or down. But then what did it actually do over that cycle period there? Or we can go back even further. But typically markets can change over 4 or 5 cycles, but we can go back in the history. I've got all the data going back further, but then look what it actually did. On the average over that 5 cycles, it was up or down 15.5%, down 26%, down 10, up 16, down 11. So, big. So look at this. If you'd done a strategy for 6% up or down, high probability winner, and that's what we did. So we did the iron condor debit spread for the price spike, and here it was trading going into the earnings right here. It was trading at 246. Really good trend up. You ride the trend up into earnings, you want to get out. And then when the earnings came out, what happened? Boom, price cratered. Now implied volatility went down, but if you had done the iron condor credit spread, this is what I'm talking about. If you'd followed the norm of what traders tend to do, only wanting to sell volatility, look what happened to you. So you would have been selling, this is about, you'd be selling about 9% up or down, all right? Now, if you're okay, so you think, well, what if I go even further out of the money, so I'm not going to get crushed. Well, as you go further out the money, you don't get any premium. At some point, that premium goes to zero, so it's doesn't give you a risk to reward that's even worth trading it. So sometimes we don't even trade something because it doesn't give you the risk reward. Now, so if Tesla, if you've been selling calls or puts, looking for that vol collapse, look what happened to you. So let's say you sold, a call up here, not the expected move 9% up. Well, look, this one went down. Let's say you sold a put, all right. This one was down 26%. Look here, if you'd sold 9% expected move up, this was up 16. You just got crushed. Loser, 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 loser. Now, if you'd gone and did this trade for a price spike, winner, 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 winner. Okay, think the opposite, and then you're thinking this is how you come into it. So if you look here and then you look there, you think, well, what can I do to take advantage of the big price spike? Well, this is what you do. So we did this iron condor debit spread. So this was basically, Tesla was trading at 246, expiration on the 26th, 3 days later. The implied move history, based on the straddle price history, was looking for an expected move 9.2% up or down. That was going into the day of the release. So set the trade up for all we had to do is have the trade move 6% higher or 6% lower. We make a profit. All right, so it's a high probability trade. Now on expiration, it was trading at 219.80. All right, look at that. Boom, it was down 10.78%. And we set the trade up for 6%. All I had to do was move 6% up. It didn't, we lost there, but it did move 6% lower, we win there. So the max risk was 160 bucks right here, doing this spread, and the potential profit or max profit was 90. So that was a fantastic return. All right, so you can see here, this was the spread, 262.5, 265, 235, 232. I'll show you here in a second. So here it is. So here's the risk profile. We're long that call here, 262.5. Long that put here, that spread. All right. Our risk is 160. The debit paid. That's it. So if we were totally wrong and this thing collapsed on us, went here, we lose 160. But even if it does come back in here, we can get out if we needed to with a less of a loss than 160. But this is based on the probabilities. This thing has explosive moves, so that's what we're playing. So if you do this consistently, certain stocks every earnings season, if you were like a hedge fund, and you did the same ones over and over and over, you're looking at the statistics and you're going to see, well, one cycle I might lose, but over 5, 10, 15, 20, this thing has this tendency. Okay, that's what hedge funds or mechanical machine algos will do. All right, so like that, looking at just the statistics, this is exactly what they'll be doing. So here you set that up. That debit spread side here costs you 75 bucks. That side costs you 85. So there's your total at risk. And then you're looking for that big spike up. This one had a big spike down right there. Trend at 219. So everything, volatility goes to zero. This thing exploded to the upside. Look, so went from 85 to 250. So that's where you had your profit. You lost that, you made that. So 90 bucks there, 56% return. And this is one where implied volatility collapsed. You're not taking advantage of that, but you took advantage of the spike. Now, here's another one. These are, this is kind of what I call my flexibility type strategy. And it's a really great strategy we use a lot in the right situation. It's called the double lightning. And it's basically a double calendar, okay? So really cool setup here. And this gives you the flexibility to ride a post-earnings trend. All right, so basically, again, these are all defined low-risk trades. You're either, based on what you're putting up as far as capital, totally defined. This one is super low risk. This is of all the different trades that strategies I'm showing you today. This is the lowest risk type trade that you can do, and defined risk cap, but very low risk. And this takes advantage of two things. It takes advantage of that pre-earnings high implied volatility collapse, but and selling time volatility. But it also gives you the opportunity, if you want to stay with a specific stock you think has a tendency to trend up after the earnings or trend down after the earnings, this is one that you're in that you can play that post-earnings trend trade. You don't have to do anything. We'll just do a couple adjustments, and then you're either going to be able to play a long to the upside or a short to the downside. All right, so trade durations on this can be 1 day. We're doing it just purely for volatility collapse, or it could be 1 week. Sometimes we'll go out 2 weeks. Okay, so this will always give us a positive data, no time decay. So it has a lot of great features and benefits to it. All right, so the strategy then is really kind of set apart from the others that also sell volatility, because this one can be adjusted into a directional trade after the earnings release, which provides you the potential for those big profits from that post-earnings trend. So you'll see so many times you're thinking, gosh, I wish I'd gotten into that trade, because of the big move up, but it's already had the big move, you can't participate, or the big move down. This gives you that opportunity to be in that post-earnings trade, either up or down. And this we started using, gosh, it seemed like it was just yesterday. We started using this back in 2020. And this is really given just really, just a really high winning percentage of trades and very low risk, if you do get it wrong. All right, so let's take a look. So here's the kind of the earnings kind of update on the alerts that I've sent out. I started sending my first alert out on earnings trades back in 2019. And through Friday, we've had 133 trades closed out, 96 winning trades, 16 break even, 21 losers, running 84% winning rate. Again, these are unaudited. These are just a summary of kind of win loss. And that, those are high percentage trades, but very, very selective. Just don't throw out a bunch. Very selective on what I do send out. Here's an example of one to show you kind of how it works. This was on STZ and for volatility collapse. And just looking at the just quick review of its kind of earnings history, implied volatility history. Looking for moves of 3.5, 3.6. Just a consistent market looking for just not huge moves, 3, 3.5, maybe sometimes up to 4. Nothing huge. But then what did it do? What did it do for me lately, right? So you can see there on the day of expiration though, look, so here it says 3 up or down. Here it was up 2, down 3, flat, up 1. So this one is a good one for the double calendar because, it's not a big mover, but we can take advantage of volatility crush. Plus, if we want to stick with the trade, we could also adjust it for the post-earnings move. All right, so here's what it looked like going in. Constellation was trading right here. Okay, implied volatility had moved up. And so the trade entry was on the 4th. It was trading 242.33. Expiration was the next day. So the next day it was trading 247.5. Not a big move. All right, so it's trading right there. So the implied move, the market was telling us it was going to be up or down 3.5%. So we set this trade up for basically that implied move. So what I like to do is kind of set it right there a little inside. So we set this for a 3% move up or down. That's what we wanted. We wanted to go 3% up or down. We want it to be at 3% up or 3% down. That would be our max profit range. All right, so this was before the open, so we set this up on the 4th. It was traded at 242.33, expiration the next day. You can see the implied volatility here of that series going in was about 2 to 3 times the norm right there. Looking for a move up or down of $8.50, so you can see the norm there. Now here's this is what we play, what we call positive skew. We're playing the volatility skew on this trade. So basically, you can see here, it's 86% implied volatility on this series here. The series behind it is 38, and behind that, 32. See, it goes down. That's what we call positive skew. All right, so we'll go through that, how that works, why it's positive, why it's negative, but that's positive skew that we take advantage of. The next day is trading at 247.53, volatility collapse. Look, 27.8. We're going to take advantage of that with this trade. So here's what we did. We set this up for a 3% move up or down. Our break even was going to be 4% up, 5% down. These are very forgiving trades. Very, very hard to lose on these trades, basically. So we set this trade up. So we had the max risk. We had $150 of risk on the trade. Okay, that was our max risk. So we had basically a call calendar, which we paid $75, and we had a put calendar, which we paid $75. All right, so that was our total cost. And then our potential profit, the best max is if we get to that 3% up or 3% down. Now, if we don't, this is what we call the sag. So what we want to do is, and I'll show you in the course how we structure it, we want to have this fairly tight. So even if this goes out in this range here, you can see it's above 0. So you would, basically break even to maybe make a little money. So these are very low risk trade. And for this to lose, you would have to have it go, up 4%, which Constellation, you can see on its earnings past history, doesn't move more than about 3%. So you're pretty safe there, or 5% down. These are very safe trades. So you're not going to lose probably that 150. If you lost anything, maybe you lose, 25 or $50. But the other thing we can do, if we want to stick with it, we can stay with the post earnings. Now, this one we ended up making $180 on the spread because it went out here. So you see that spread, blew out. The call side went from 75 to 293. We lost on the put side, but very little. So all in all, this made $180 on a risk of 150, 120% return in one day. So these are exceptional, really cool trade. These are just a neat trade in general to use. Okay, so that's the double lightning, and here's just another example to show you how low these risks can be. This was on CL. We set this one up. This one was pretty interesting. This was, you can see here 3% moves. What did it do the next day? Very low. Came in at around 2%. So very, very what I call consistent. So we set this one up, double calendar, and this was Colgate, and trading here was up here at close. Look at the volatility collapse. So the expected move for the stock was 2.83. We set the trade up for a 2.5% move up or down, and you can see here it was going in. You can see the implied volatility. On that 83 is where we're going to have a short strike there, was 46.42 on that exact 83 strike. And then you can see the next day, you can see the vol crush the next day, it was trading at 14. So that's what we're taking advantage of. All right, so here was the trade. And then look how cheap this thing was. The total risk of this trade was $17 right there. So we had a call calendar cost us 11, the put calendar $6, right? So we had a total risk of 17. Now look at this thing, it shot, it went right, almost nailed it to our 83 strike. It was trading at 82.83. So this went from that spread cost of 17. Now it was up at, we had a profit of 36 bucks. So that 11, went to 53 and the 5 went to 0. All right, so we made 36 bucks. I mean, these are just, ways that you can play earnings. So you're not just sitting on your hands. It gives you the opportunity. Here you made 36 bucks, but that's a over 200% return in one day with very little risk. Okay. Plus, if you thought, you wanted to stick with Colgate for a post-trend move, this gave you the opportunity to do it. And of course, I'll show you then how you can make the adjustment to do it. So this would have been a pretty good one to trade the post-trend trade. You can see here it went up, had a couple of days up, and then it went flat. But that would have given you a chance to play the next week after this post-trend move. See, so here, because if you look at it, what you're doing here, this is the key. So if you did want to stay with the call side, look, so we were short that the call and the expiration, the earnings when it was released, but we're long the call behind it. So we could stick with this trade for another week if we wanted to, and that would have been a great one to do that. I'm not sure we did it, I can't remember. Now, the next thing we can do is what we call the earnings paired trade. So this is a fantastic strategy, market neutral. Yeah, in the course, we'll go through the bucket. I'll teach you everything you need to know of all these strategies, just very detailed. And then, you're just going to get, it's a master's course on this stuff. I've been doing this trade options for 30 years. So you're gonna, there'll be no questions. And if you have some, that's the other thing. The course is set up so you can ask questions as we go. And then we'll have a follow-up Q&A, plus you'll be able to come to the trade room. Now this is, hedge funds are called hedge funds because they typically pair trade. They go long short, okay? And this is called what we call market neutral strategy. So it doesn't matter if the markets now are going straight down, right? Hedge funds, if you're hedged, if you have a pairs trade, and your relative strength between what you're buying or selling is correlated, it doesn't matter if the markets go up or down. You're just playing the relative strength of one stock or whatever security relative to something it's correlated with, paired with. All right, so this is when I was running the trading group, this is all we did. Everything we did was a pairs trade. All right, so it's a market neutral trading strategy that's used for, we're going to use it for post earnings trend moves on a stock after its earnings release. So by trading at pairs, or you could call it a spread, this helps to mitigate any overall market risk. So you don't care if the market's going straight down, you could care less because you're playing this as a spread. One security relative to another security, so that spread, you're playing that correlation, that relative value. That's it. Doesn't matter if the market goes up or down. You're just playing the spread. So by simultaneously taking an opposite position on a related security allows you to reduce exposure to broad market movements. So in other words, a pairs trade is equally likely to profit whether the market you trade goes up, down, or sideways. It doesn't matter. Now we're going to do this using also synthetic options. So it's a really cool trade strategy. You might decide this is all you want to do for all your trading in the future, which I do have a course on this as well, just strictly on pairs, but we're going to go through this setup here in the course, how you can do it. Now, think about this. So let's say you think, Apple, take Apple, for example, and you think Apple's getting weak. So you think, you want to short it or you want to go long. So let's take a look. I'm going to show you an example of QQQ. So let's say you think QQQ will go up faster than the short side. So what you're going to do is you're going to pair something with it. So you think QQQ is going to be stronger than Apple. Apple's really been kind of losing its momentum, right? but it's correlated with QQQ, right? It's a tech stock. It's forgot what percent of QQQ it makes up, but it's highly correlated. So what if QQQ goes up faster? Now the market's rising, but QQQ goes up faster than Apple. Apple goes up a little bit like that. So you can see that spread widening. That's what you're playing. Or let's say QQQ goes up, but Apple goes sideways. Playing the spread, so you can see how so if you bought it right here, that spread, look at it widening. That's what you're playing. But if the market goes down, the spread's still widening, because if the market's going down, Apple's going to be probably going down faster than QQQ, or QQQ is going sideways, but Apple's going down. That's what's been happening more so, right? Or QQQ is going down, but it's going down less than Apple, right? That spread. Or QQQ goes up, Apple goes down. So that's what we call a spread trade or a pairs trade. So it's market neutral. You're mitigating the overall directional, you're mitigating the directional risk. So it doesn't matter. All you're playing is the structure, the relative strength between one versus the other, and that correlation. And so we're going to do this using a synthetic pair, which just combines using options versus the shares, okay? So very cool thing that I'll teach you in the course. And so we can pair, typically we'll do the pair trade with a stock paired with the ETF that it's correlated with. So it's going to lower your trading costs in the hassle of borrowing shares to short, and just a very great way to play a upside or downside move. And in this case, we don't know which way. So here's an example. And so this is what I was showing a little bit earlier in that pairs trade. So for example, here's Apple, and this is two examples. So it had earnings on the 4th here. So you can see right here. And so it spiked up, and then it went sideways, right? And then it started trending. Okay, so this is Apple. We'll show you that then paired with QQQ in a minute. And then here's Apple again. Earnings, collapses. It trends down, right? And then it starts up, right? That was on the 3rd. Okay, so here's what the spread looks like. This is just a correlated spread 1-to-1, where we're not adjusting the spread for a dollar value, which in the course I'll teach you how to do it dollar equivalent, where we're making it, if you have a value of 100 on one security, and we want to make the other value relative to 100. I'll show you how that's done and not confuse you. But this is just a 1-to-1 relationship. So if you bought one share of QQQ and sold one share of Apple, here's the spread. So at this point, on the 4th of May, that the spread on that spread value were QQQ minus Apple. QQQ at that time was $152 over Apple. If you did one share, you bought one share of QQQ and sold a share of Apple, that would have been, the spread would be $152, okay? Now, you can see, these are my indicators, which are really helpful, but you can see here after earnings, look what happened. The spread started trending. So this means that the spread, you're long QQQ, short Apple, that's all you're playing. If the market was going down, you don't care, you're just playing the spread. You think Apple is weak, and so you're going to take advantage of it but you're going to be paired or spreads. You're not going to be exposed directly to market moves. So let's say you thought Apple's going to be weak and you wanted to short it, but the markets are going up, so it's going up in your face gradually. But here's how you play it. So look at the spread. It went from 152 up to, on the July 18th, now it's 191 right here. Okay, went from here, right here, 191. So that's 191 from 152 to 191. That's a $36 per share move. Now we're going to do this with options. So one option contract is equivalent to 100 shares. So if you'd done this pairs trade just 1-to-1, you'd be up $36 per one share, but we're going to do it with options. So you're up $3,000 $600. That's one contract. So if you did 10, you can do the math, right? So really cool way to trade. And again, this is all I used to do was pairs trade, my group. Okay, so here's another example. So here it is on the 3rd, and it's trading at 183 right here. And then on the 14th, it's trading at 201 right there. Okay, so here's the pairs trade. So when it's going through here, you've got a very controlled risk, and you're hedged, right? So if the market did collapse, you're hedged. So, you're long short, but so the trend did move up. And so from that, it went up to, that's an $18 move. Okay, so here you'd be up $18 per share. That'd be 1,800 per option contract, doing it as a pairs using options, which I'll show you in the course. And here's one more example. Here's Nike. So here's Nike on the 29th of June. And you can see earnings right there, collapse straight down. And then it just goes sideways to down. Just you've seen Nike, okay? And here's Nike on the 28th, spikes up. All right, so here's the Nike. So here's the spread between the two. So this is also adjusted on dollar equal basis, okay? So here's the spread relationship here. So on the 29th of June, you can see Nike is right here. It's trading at 72 over right here. So Nike is $72 over SPY. And then look, it's going down. So you're going to be, in this example, you're short Nike, long SPY. So then that relationship went from 72 over. Now Nike's only is $14 under right here, $14 under SPY. It went from 72 over to 14 under. So you played that spread all the way down and you made $86 per share. If you did with the options, that'd be 8,600. That would be one option contract. Here it is on the 28th of September, right there, trading at 2.5 under. So at this point, Nike was $2.5 under. Here you go long Nike, and the spread starts moving, starts trending, and then right here, it's $81 over. So it went from 2.5 under to 81 over. So you're up $84 per share if you did it with shares. If you did it with an option contract, and I'll show you in the course how to do it, you're up 8,400. So really great way that you neutralize your risk, mitigate your risk, but you're playing a relative strength stock based on, and what causes this correlation break is the earnings. All right, so you learn that. Now, the next thing, will every trade be a winner? No, I wish it could be, but I guess if every trade is a winner to you, then you'd probably be looking to do something else, you get bored. But, what works is, again, it's very important, a systematic approach for finding the highest probability trades. And so with this course that I'll be doing next weekend is exactly what you're going to be getting. So let's talk about more of the course and everything you're going to get, and any questions that you have. So this course will be next Saturday, the 5th, and 11 a.m. Eastern. We'll start. We'll run it to about 2, or if we need more time, we'll go over. We have questions, and we'll finish up Monday, the 7th at 4 p.m. Eastern. Again, use this link to get the special discount today, and then again use that code EARN15. And you'll get this 15% discount. So let's go through everything and then take more questions. Now, here's just a nice note that I received from one of my customers or members that took the course, Mark. He said, Larry is a great teacher. I've had a few, and Larry by far is the best. I also enjoyed his earnings course. I made 3 trades in the past couple of weeks. Larry would be happy. I followed his teachings and traded AVGO Broadcom for over 1,000% winner. Pretty damn good on that. I must say, I'm not sure if things are finally starting to click for me or if it's Larry's awesome teaching, but I'm trading better than I have ever traded in the past 3 years, close to 4 now. Probably a combo anyway. I'm not tooting my own horn here. I just wanted to leave a comment that's positive for Larry. So I've been through a lot of different programs, seminars, trading groups. What you're doing here is by far the best in my opinion. So I think that's a pretty good summary, and I appreciate that very, very much. So that was from one happy earnings course participant. So again, here today, here's what everything you'll get. You'll get the course when I go out over next week, going into next Saturday. This will be offered out at $197. You can get it today with that link in the promo code EARN15 for $167. Plus, you're going to get my on-demand course on earnings. This is $297 on the website, 7-hour plus. This one was really extensive, but that was what you'll get there. And then you'll get 30-day trial membership to the club. You can start it whenever you want. If you want to wait, until after the course, you can do that, but that's $97. Then if you want to renew, it's $97 a month, or we have other programs that you can use if you want to stay on, which hopefully you will. Then you'll get my Start Trading Options course. That's $197 on the website. The Q&A follow-up is $300, and then you'll get my Greeks on how to use Delta Gamma Theta. Really good course, a little short review of that, and then my stock list. Okay, so these will be current on this earnings season. And in the course, I'm going to be teaching you how to screen. A big important part of the course is your analysis. Okay, so we'll get the new course. We'll get started. We'll break this down once the course is done in 30-minute modules or less, kind of like chapters of the book, so you can go back and review, study the course. It's very extensive, so you're going to have a lot that you can go back to review. All right, so value over 2,600. Well, it's 197 today. You get it for 167. If you want to do it with my alert service, which again, I showed you some of the results there on the earnings side, but I'll show you some of the other things that we do. High winning percentage on all the trades, very selective. So you can add this in course package 2. So this is really giving you more help and guidance in your trading, which in this environment, you really need some help and guidance. Not that I'm perfect, but I've seen a lot of the stuff before, so I can navigate it probably a lot better than what you're doing. Hopefully, it's pretty crazy, that's for sure. But anyway, I'll be there for you and, to guide you, mentor you, whatever, if you want to, do this package. So you'll get my 5 different alerts that I send out, and you'll get this for the next 4 months, plus our trading club, which is great because we have the trading room, which we'll go through on that. And then plus you'll get, again, everything course package 1, all those bonuses, but you'll get the alerts, the different 5 alerts for the next 4 months. Now, with the alerts, we'll go through a few examples to show you, but we do a lot of butterfly and what we call long condor trades that I'll send out. We also do a lot of counter diagonals. So this is another kind of part of the alert. So, 1, butterflies, 2, calendars, okay? And then we do, in certain situations, we do these penning trades using butterflies or a calendar. Breakout reversals, these are typically usually credit spreads, and then very selective earnings trades, okay? So with the alert service, a lot of members, they'll do their own thing, but I always send out an option strategy to use. And so many of my members they've learned how to trade options just from the alerts that I send out, because I'm very descriptive in the alerts. And then, you have access to the trading room so you can ask questions. So it's a really great way for you to learn as well. So with this package, it's $597 when I go out next week, but today you can get it for $507, plus there's a 2-pay. And, typically 8 to 12 stocks or ETFs every month. Again, either butterfly, we've been doing a lot of long condors lately, and that's because the uncertainty of the market has really reduces our risk, but gives us some potential for big potential returns. I'll show you a bunch of examples. And then we do a lot of calendar diagonals, show you those. Do a lot of butterfly pins. I'll show you some of those here in a minute. And then breakout reversal credit spreads and very selective earnings trades. When I send out an alert, I will always give you the option strategy to use. And again, some members, they're just looking for the stock or the ETF, long short that I send out, and they'll just buy calls or puts. But I will always give you a spread to make sure it's a lower risk, and we cut down our theta and stuff like that. I do a trade setup video review after hours, after the night, with a video review of the trade and what else the market's doing. The trades that are sent out are listed in archives, so you can go back and look at it. Then we'll do, we have a weekly Q&A every week. This is also live and recorded. Access the next 5 months. Daily video newsletter, what the markets are up to, what we did that day, what we're looking at the next day. You'll have that every day for the next 4 months. And here's a big plus, the virtual trading room. This is open to you every day during the week. And this you'll have for the next 4 months. We open up at 9:30 Eastern to 10:30. So come in there and sometimes we go over because the markets are doing whatever. But if you have a trade on you need help with, or I send out a trade, I'll show you what we're doing on trades. And if you have a question on any trades, come in and ask there. And then anything on my website, you can get a 60% discount on all my other courses and software. So you'll have a members code that will allow you to get anything additional you want on the website. So yeah, here, Charlie, here's the link again. Use that, and then use that special earn 15. So that's what you can get there. Now, yeah, and if you do want to buy anything, you're going to be getting the 60% discount. You'll get a members code. So you just go into, go to Power Cycle Trading. Let's say you want some of my trading software, just go here and you can buy, my scanner, that I use for volatility scanner. You can buy my directional trading indicators. Now today you can get, if you do the 195, you're going to get these studies, okay? So you're going to get a pretty good deal on that. And I've got these available for Thinkorswim, TradeStation. So you'll get all, so if you go to my website and you go here and you put, buy it, add to your cart, whatever, this is with the course. But if you want the indicators, all that stuff, you click here, add to cart, and then you put in your discount code. We'll have a members code here. It'll knock it off. That'll be 60% off, okay? So anything, any of my indicators, and then any of my courses, if you want any of my other courses, you can go here. You'll see different courses. You go there, you can see my earnings courses down here. You're going to go to the website and buy that, which during earnings season, I get a lot of people coming in and buying it. But if if you'd waited, you're going to get it today for 167 plus all the bonuses. As we go here, you can see it's right down here, 297. All right, so this gives you access to a lot of good stuff there using that members code once you're a member. If you do it the course today, 167, you get a 30-day trial. You can buy everything on my website still for $60. Now here's the overall, overall situation with the alert service. I showed you this earlier, so I won't, go spend a lot of time, but started back in 2018. So I've been doing this for a long time and been maintaining a win rate of 79%. All right, so again, full disclosure, unaudited. These are just summary of win-loss over that time frame of the 5 different services. Now here's the earnings service, which I started in 2019. I showed you those results earlier. Here's an example of one we did this earnings season. This was on, well, here's that. I don't, if you need that, I don't think you do, but here's, all right, we'll go through that. That kind of threw me off. But again, if you want to see if you bought it in the past, here's your, it'll show you here on your club tab. And also then one other question I tend to get a lot is about the bonuses. So you may have some of these already, but these are included free of charge as an additional bonus The course alone, again, is worth more than the package, but these I'm just throwing in as a bonus. So basically what you're getting is the course for 167 today, but you're getting those bonuses in addition. We'll go through that trade setup on the earnings in a minute, but here's what the basic summary of the course, what we're going to look at, and I'll show you and teach you. In part 1 and part 2 are the live part. You're going to also get a part 3, which is on demand, but this is the live part that we'll do Saturday and Monday. So we'll go through the 5 steps that I use to perfect trade setup. So the analysis and the analysis tools used. This is probably the most important part, okay? We'll go through kind of what I put together, a 7-step screening process to help identify these trades that we're looking for, how I screen and process to do that, how option pricing, the importance of using weekly options, what the importance is, how that works, the source that I use for my statistics, for my earnings history. So this is a big plus that you're going to learn in the course. We'll go through that, and then how to use it, and then how to scan using these statistics, how we can scan building our list. I'll show you the scan setup, and then how we can get our list sorted and scanned to capitalize on the certain earnings trades we're looking to do, and then how to analyze it. Very important. How this is the most important part. The history, and analyzing the earnings statistics, okay, to determine what strategy to use or not to use, and then the kind of formula that I use for kind of setting up the trade. It's kind of a step-by-step checklist. So it's very clear and a very step-by-step approach, so it'll be easy for you to follow. And then we're going to go through the strategies. So we're going to go through the iron condor in great detail with great examples, current kind of examples, really detailed there. This is the one for volatility collapse. We'll go through in great detail the iron condor debit spread for those price spikes. I think we're going to have a lot of price spikes this earnings season. So this is probably the one that we're going to be maybe using the most. Then we'll go through using the double calendar. Okay, so here it's absolutely the best earnings strategy I've found as overall excellent option strategy, period. So that was referring to the calendar. And so you're going to learn how to use it, man. It's a great strategy. So then we'll go through the details of how to use the double calendar, how you choose it, the optimum strike price, how to structure the initial setup through option expiration, and then how to adjust. So once we get into double calendar, we can adjust it to a trade for either post-trend trade up or down. And a lot of times what we're going to do is we'll look to see if we get it right, the movement, a lot of times we can adjust it into a free trade with zero risk. So I'll show you how that is done. And that, like I said, no kidding. So a lot of great stuff that you're going to learn in this course. And the good thing is it's only today $167. So that is a pretty good deal. So here, Martha, here it is, EARN 15. Put it there. And here's one last thing. We'll put it here, make sure that you understand. Well, we'll finish up. And then, okay, so that's what we're going to go into the live course. And then we'll go into the specific trade setups, okay? Again, so we're going to go through that long iron condor, the iron butterfly. Now this will be in the recorded part, okay? So there's so much to these earnings trades. In the live course, I want to specifically kind of concentrate on a couple of different strategies, but then what I'm doing here, I give you part 3, which is the recorded, so you're getting everything. You'll see all the different things you can do. But in the live course, I'm kind of more focused on kind of current market, right? But then I want to have everything to you. So this is what you're going to get in part 3, which is on demand, which you'll have. But it's a great, great stuff that you'll have. So you'll have all that, and I mean, it's just so much. So the strategies will be, explained in great detail how, why, and when to use, using the examples on each. how to construct the earnings trade based on pre-earnings implied move history, how you calculate that implied move, and then how to set up and when to set up all trades. You're going to also get a trading library. And again, you're going to get my updated 3 lists of different earnings trades that we're going to be looking at over this earnings season. So with the earnings library, it goes back, you'll have, actually it's more than 40 trades. So you can go back and look at all the different types of earnings trades that we've done in the past. A lot of times that's a great way to learn. And here's here was from Mary. She gave me this note. She said, course explained in clear and simple terms how to trade options on stocks that were coming into their earnings report. Larry showed specific sources of information he uses to determine what strategy to use, which is most appropriate for that stock that is reporting based on its historical data. So again, this is a really big key to your earnings winning trades. So this earnings history and how to analyze it is a big part of the course there. He gave a very specific guidelines as the use of each and also exit strategy. Goes over the material in great detail, shows examples of strategies from past performance. One of the things that impresses me with each course I've taken is his willingness to repeat explanations if someone asks for clarification. Larry schedules his classes for certain time frames, and because he wants to ensure that each participant has understood the information, he most often time goes over the planned time. So that's why I say this course will start at 11 to 2, but a lot of times we go over just because I do want to try to make sure I get all the questions answered. All right, so, and then the enroll, I've got a question here, hold on. Oh, thank you. Thank you so much. If I may pass that on. Wow, thank you so much. Here's from one of my good members. See if I can copy that and paste it for you. Thank you so much. Wow, you made my day. Let me, hold on a second. This is what I enjoy about teaching this course and just teaching in general. Thank you so much. Here's just something I just received. Thanks again. All right, so anyway, you'll get my on-demand earnings course. So this was one that you can start right away. So as soon as you sign up today, you'll get this Monday. It's a weekend, but you're going to get this. So you'll get my on-demand 3-part earnings option course. So this gives you immediate access, so you can get started right away. Yeah, you can start. If you can't start till the 1st of May, it's all, it's on, it'll be all recorded, and then you'll have everything, all the additional bonuses, and you'll have this course right away. So this was actually 7+ hours, but anyway, 428-page PowerPoint manual. So this is on demand, but then when we do the live course, you will get that. The live course, we'll cut that into, chapters, modules, and then you'll get that plus the PowerPoint handouts. So you'll have that in addition to this course, but this gives you a chance to get started right away. And this will go through all the different strategies, the double calendar, the iron butterfly, all that stuff, so you get this right away. I wanted to get this out to you so you're kind of, if you're, want to get up the learning curve and do it really quickly. And then you're going to get my 30-day trial membership. This you can start, anytime you want. And then if you want to renew, you can. It's going to be $97 a month, but you're going to get one free month. Plus, we have other types of packages. But the main thing here, you get the access to the trading room. So 9:30 to 10:30 Eastern every day during the week, Monday through Friday. Really great place to come in. I mean, with this kind of market, it's very helpful to hear how I'm approaching it, my plan of action. And then if you have any questions on any of the things you're doing, you can, get me to look at it, get my intake, my input for what that's worth. And then also, we do a lot of trade setups that you'll also see what we're doing in the room on potential alerts that we may send out. All right, so you'll get all that. That's the big plus there. And then you also have access to our video updates every day after the close. Then you'll have access to our weekly Q&A live and recorded every week, over the next 30 days. I have the Traders Educational Vault that's got some really great exceptional course material in there that you'll have. Plus, you'll have that discount. You'll get a discount code that you can use. So here's one thing that I always want to point out. Jay, one of my members, has said, reading books is fine, but seeing the actual option trade setup makes a huge difference. And so that's what's going to make a big difference in your trade, and come in and see, what we're looking at, how we're doing it, and then your questions on anything you have. And then you're going to get my Start Trading Options as a bonus. So this is an on-demand course, kind of intermediate course. So going through the benefits of options, what you need to know, about option basics, how puts and calls work, how option expiration works. And then you're going to learn, there are 3 strategies in the course that I give you: cover calls, how that works, cover call strategy, and then cover call with the protective put, which is a great one to know right now. You'll learn that in the course, and then the vertical debit spread. So a really great course you're going to get as a bonus course for you. And then you're going to get, we'll do a follow-up account Q&A. This will be Tuesday, after the course. So you'll get that right away, so you can ask whatever questions you have. Yeah, sure. One second here, Shamish. Let me find that. 1 second. Bear with me. Okay, here, had a question I want to answer real quick here. All right. So, wait a second here. Hope that answers that. Let's see. We send email members for course. Yeah. Oh, yeah. Question is, will I send out email reminders for the course and live sessions? Oh, absolutely. We keep you posted. Yeah, we definitely do that. Want to keep you in the loop. All right. So that's definitely done. So you'll always know what's going on here. Plus, if you want to, in the future, just something additionally to show you, if you go to my website, Power Cycle Trading, we will have it posted right here on the front page, upcoming live events. So you can always see what's coming up. We always have something planned for every weekend. So for example, this weekend we had the, this setup, but then you can also get priority notice for, things that are coming up. All right. And then you can also, put in things that you maybe want. Somebody asked here today, they would like to Fibonacci course. So I'll be doing that in the near future. All right, so you get that, and then you're going to get bonus 5, how the pros use the Greeks. Okay, so this is just another great little thing to add to your option library. So it's a 60-page option guide with videos, primarily focused just on the Greeks, like delta, gamma, theta, how they work, what they are, option pricing, what we call the market maker secret, more on standard deviation, option delta. So you're going to get so much option educational stuff, with the bonuses. And you're going to get my 3 earnings watch list that I'll do. And then in the course, you'll learn how to do this screening yourself, but you'll get this. And this will be based on movements of greater than 5 or 6%. I do a screen on 7% and 5%. You'll learn how to do this in the course, but you're going to get this right away. So here's kind of an example what those would look like. Here's one that this was for a max move of 7%. So we'll give, this screen will give all the different stocks that fit that parameter, that bucket. Shows you the average volume, the earnings date, things like that. A lot of good detail there. The main thing is to know when it's coming up, the earnings date, and I will actually give you the strategy too. And here's, list 2 was done for greater than 6%. These are like here's Tesla, Team, Deck, things like that. List 3, greater than 5%, breaking it down a little bit more. List 4, etc. So, and then here's some examples of our alert service. I'll show you a number of different ones we've done just recently. Here's Dan. Here's one of my members that signed up for the alert service. He said, very diligent and totally thorough with your analysis, the foundation of your success for your alerts. I paid for my subscription with the first 4 trades I took with you. I was learning how to trade options. Please feel free to share this information. And then Scott said, it'll be the best investment that you ever make. Go with the elite package. And again, if you want to do that, that's package 2. Now, again, just to clarify, when I do send out an alert, again, a lot of members just want the trades, want the stock or ETF, and they'll just do their own thing, buy calls, buy puts. But I will always give you an option strategy based on what I think is appropriate for the environment we're in currently at that time. I'll give you the suggested option trade, the entry level. I'll give you the profit take levels based on what we call option target analysis that I do. What option series to use, stop loss guidelines, profit take levels, and then if there are adjustments, I'm constantly sending out alert updates, adjustments if we need to do that. So then I'll do a trade video review that night, of that trade to tell you why in more detail I did it. Daily market video newsletter, you'll have that every day after the close. Access the weekly Q&A live and recorded every week for the next 4 months. Access the virtual trading room for the next 4 months, and discounts 60% off in the educational vault. Okay, so here's an example. Here's one. Now KG, KG was an animal. He used to love the earnings trades. He said here, I made a lot more than the 12 back then. I was charging $1,200 for the alert service in my first trade. Larry suggested in text, great price traders. Yeah, it's a great price now. So here's the alerts. Okay, here's one we did recently in the last earnings season. We had this was on AKAM, and this was for a big price spike. Okay, so the earnings were on the 20th. It was trading at 98.15, and we took profit the next day. It was trading at, look at this, 76.83. So this was for that price spike. And so here, very detailed. I won't read it, go all the way through, but it said just basically new AKM earnings iron condor debit spread trade for more advanced option traders. Just very detailed when it goes out. Okay, so you have plenty of time to go through it and see how to work it. I send this out way before the close, so it's not right on the close. So you'll have plenty of time to use it and work the trade if you want. And then here it was on the 21st, the next day. When this was sent out, it was trading, let's see, we were trading here at 98. I can't even find it right here. Yeah, when I sent this out, it was trading at 98.15. Then the next day, 76.83. So it was down 87.48. And anyway, I sent out all these instructions. So you're always clarifying things for you. And then here's what the trade. So we set the trade up here. Here it was the next day. So did this setup. Here's the parameters of the trade. So it's trading at 98.15. So the expected implied move history was telling us 10.8% up or down. Set the trade for 6% up or down. Next day, it was trading when we closed it out or at the close, and we didn't really have to do anything. It was trading at 76.83. It was down over 21%. So we set this trade up. I'll show you this next slide. It'll be easier for you to follow that. Here's what we did. Okay, you can see here somebody asked they didn't see what we bought. So here's what we bought. I'll teach you how to do this in the course. Why I bought the 102 and we sold the 104. All right. Okay, and then we had bought the 94 put, sold the 92 put. What do you call that? Put debit spread, call debit spread. Look where it was right here, down 20-something%. So this thing blew from our cost of the trade, 145, max profit. We had, 200. So you can see the spread was $200. Okay, and we paid 145. So we made 55 bucks, 38% return. And that's because of this. Well, I don't have the history there, but this has a has a big tendency for these big moves. And that's the big part of the course to teach you that. Now, if you do the alert part of the service, which I'd highly recommend, here's just some of the stuff we've done recently. This is we do a lot of butterflies and condors. And so we've had, since starting this part of the service back in 2019 through yesterday, we've had 212 trades closed out, 151 winners, 17 break even, 45 losers, win rate 79. These are high winning type trades and the low risk, the average, risk or loss is 75 on losers. We have, we're running a high winning rate, so we don't have a whole lot of losers. And then there's potential to make 2-to-1 to 25-to-1. I'll show you one where we made 20-to-1. Okay, so these are really amazing types of trades that you can do. So here's a couple of things we've done recently. Here was a short trade that we did on IBM using a long put condor. So when I send out the trade description, this is Telegram. They're a really quick service, really descriptive. Here it says this was on the 18th of March. New IBM short trading at 246.45, daily cycle, high retracement reversal, etc. I'll tell you what it's doing technically looking. And then I show you what target we're looking, target 1, 242, target 2, 235. Buy the condor here, okay, at around 75 cents or 75 bucks. That was on the 18th, and on the 21st, it's trading. It went from 246, now it's trading at 242. The condor that we set up, now that condor is up to $160 per spread, up 228% return. Yeah, so you understand the put debit spread the counter, but the condor and the butterfly still. Yeah, well, that's a good reason. Then hopefully you'll sign up for the course and you'll have more clarity on these types of trades. So that's a good reason to join us right there. So here's the link if you do want to learn. And then also remember, if you can't stay with it, it's recorded and it's yours. It's yours forever. So you can't make it through the whole thing, and you do, have to do other things. You get tired. You have the course, and you're not needing to sit there. So here's the trade on IBM. We went short right here using our indicators, and we got out right there. And here's the trade setup. I was just trying to get the link for you again here. It's powercycletrading.com/. special. If I can get that to work here, and then use that code earn 15. So yeah, here's one that we did not too long ago. This was here's the link again. All right, so this one we did on IBM, and this was with what we called the long put condors. So we were long the 245, 242.5 put, short the 235, 232.5 put. We had a total risk. In this kind of market, I want real low risk. We had $70 of risk, okay? With the potential to make, it's a $2.5 wide spread, $2.5, 250 less 70 our cost. Potential profit 180, 257% return. Nice leverage risk return, but on a risk of only 70 bucks in this kind of market. That's what we have been doing, a lot of long condors. And so here's what that looks like. The risk profile of that trade went out right there. So we went from our cost 70 bucks to $228 right here. Trade at 242.35. So the spread was, cost 70, went to 228. We had a profit 158 bucks per spread. That's one spread. If you did 10, you can do the math. If you did 20, did 1,000, whatever, 225% return. That was on IBM. So this was an alert trade just sent out, March 18th. Here's another one. This was SPY. Oh, yeah, I hate that. That's so good. Yeah, here's a good one. This is from First Last. That's an interesting name. He said he's going to buy the course, but he said, by the way, you sound much more professional for one reason. You're not telling me there are only 9 spots left. Yeah, and I don't have a jet airplane or a Ferrari in my garage either. I have a Subaru. Those commercials are just, they're make me laugh. Anyway, yeah, I guess I am professional. I've been doing this for 40 years, but anyway, so here's one we just did, SPY. This was a really cool one. This was a one that we set up. This was a put condor that we adjusted into. I won't spend too much time. I'll just kind of give you the highlights, but we set this up on the 10th. New SPY, we reset, we did this reset short. We had a short, we reset it, and this is what we did. So it's trading at 568. Did this trade setup. We did it with the debit spread initially at 85 cents, and then we adjusted this to a put condor on the 11th, the next day. So sent out very detailed how to do that. And then on the 11th, now it was trading down to 258. So it said if you're long the adjusted put condor, here's what it was. Show you exactly what that was. Current price level into close, do nothing. All spreads will expire worthless. Currently up $205 per spread or 476% return. And then here was this was at 245. Here it was going out right into the close. This was trading now at $257 per spread, up 597% return. So these are, very selected trades, and that's how. So went short here, getting out here, indicators we were using. And here was the trade setup, kind of the profile breakdown. So we adjusted this into the condor. We were along the 563, 560 put, then we adjusted it, sold the 550, 547. All right, so look at our cost. We adjusted our cost down to just 43 bucks. Spread width, $300, risk of 43, potential to make 257, 597% return, and that's exactly went out right there. Boom. Okay, so so you can have Telegram set up on your computer. Okay, you can set it up on your computer. So you can ask us, send an email, support@powercycletrading.com, and then set your Telegram up on your computer, and it'll be easier for you to then follow. Okay, and you can do that. You can it's easy to do. So you can also probably do a YouTube video, and it'll show you how to do it. But you can email us support, and we can help you out. So yeah, so here it is. Here's where it went out, right here, right there. Boom, perfect. So it went from 43, our adjusted price, to 300. We're up 257, 597% return. That was per one contract. And then here, these are really fun. These are very selective, but here are a few of these that we've done. These are what we call the lotto trades. Here's one we did not too long ago on NVIDIA. We did this on the 12th of March. And we did this, NVIDIA was trading 115. And then we set that up on the 12th, out the 20th, and it was trading at 119.66. So the spread was at 131. This was up 503% return. So I won't go through, this is Telegram. So in NVIDIA, it's called what we call a binary monthly butterfly penny trade, option penny trade. And we set this up for 30 cents. We set up for 30 bucks, okay? Or thereabout. I said put around 30 bucks. And then you can see here on the 20th, now it was trading from 115, it was trading at 118.81. The spread was currently up $85 per shred, 386%. And then here it was later in the morning, it was now trading at 119.66. The spread was at $131, up 503% return. So this was NVIDIA, and you know how crazy wild NVIDIA is. So you're in this trade for 30 bucks. So that's your risk, 30 bucks. And it went out where you were, actually we got into this one at 26. But so when I sent it out, say around, so we were in this one for 26. So we had the 118, 122, 122, 126 butterfly, okay? Our cost was 26 bucks. It's $400 widespread. Less 26, potential to make 374. If we get that pin, that'd be over 1400% return. Well, we still had a lot of potential profit in there. We didn't get the max profit, but we had a risk on this trade traded in NVIDIA at 26 bucks. So it's like 2 cups of coffee. And, got out here with, it was trading at 119.66. So the spread went from 26 to 157. We're up 130. That's not bad, 131. That's a 500% return. And on one contract, and only a risk of 26 bucks. If you did 10, that's a risk of 260. Here was a really good one we just did recently on SPY. This one turned out really well. So we set this up on the 6th of March, trading at 573.80. So new SPY penny trade around 573.80. Binary put butterfly. Buy this butterfly 40 cents or lower. Okay. And so then here it is on March 10th. It's trading now at moving towards our butterfly body, which was right here, 560. So we were currently up here now. You can see here at 235, it's trading at 561. Put butterfly, and now this is up around $232, 595% return. Okay, so I'm sending out updates constantly. Here's the short, here's where it was. Yeah, well, you'll learn the butterfly structure. That's a big part of what I teach. So you'll learn that. You'll learn the butterfly. This is why you should sign up, because or become a member, because we do a lot of butterflies. So here's the setup. So this was 565, 560, 560, 555 butterfly. Yeah, I'm going through these just a kind of summary, but I teach these in really great detail. So we set this up for $39, 39 cents right there. So the spread width was $500, 500 less 39, 461 potential to make over 1,100% return. And we made almost to the penny that much. This is going, we will leg out, I mean, not leg out, but scale out, but here it was right at the end, right at the end. We almost perfectly nailed it. So it went from 39 to 456. Now, like I said, we're scaling out because you're not going to leave your whole position for this, the last minute of the day, but just to show you how amazing these are. So this went from 39 bucks, our entry, to 456. So it's up $417. Okay, so that's a 1,069% return over that period of four days. So that's an example there. And then here's one last one to end with. This was incredible. This is the best one ever. We did this one. This was, again, these are all alert trades, okay? So this was on Tesla, and it was traded at 189.35. And then we had this set up on the 8th for expiration on the 16th to pin at 200. It pinned to the penny at 200. So this was up $231 per one spread, 1,925% return. New Tesla binary monthly butterfly pending trade at 189.35. Trade set for potential monthly expiration at 200. Buy the butterfly 197.5, 200, 202.5 at $12. Boom. That'll be your risk paid. No adjustments. And then here it was on the 16th. It was trading at $200. This was at 2 o'clock, 2:50, and then it was trading at $200, going up about 215 per spread. It was up 215, 1,791% return. Take profit here. Wow, almost perfect pin. Tesla trading at what was $200. It was up $230 going into the close, a 1,916% return on that 12 bucks. So here was the trade right here. Here's where it went out. Here's just the structure: 197.5, 200, 200, 202.5, $2.50 wide spread, 12 bucks risk, 12 cents debit, 12 bucks, $250 wide spread, 12 bucks, 238 potential profit on a pin there, 1,983% potential. And we, at the end of the day, this was perfect pin. Again, we're scaling out. That's where it was, right at the end. So perfect pin. So it went from 12 bucks to 250 bucks, $238 per one spread. That'd be, do the math. Pretty cool trade. And in this market, we did that SPY butterfly because it was so crazy. We did it for 26 bucks risk. So that's it. Oh yeah, and calendars, we do a lot of calendar diagonals. Here's just the summary there. Started these back in 2019. We've had 327 closed out, 236 winners, 20 break even, 71 losers, 78% rate, again, unaudited, just the summary. And then here's one we did. Like I said, we've been doing mostly calendar and butterflies lately because when I do the trades, I do it based on the market condition. And we haven't had good conditions in this market for these calendar diagonals. So here's one that we did. The last good one was in January. So new CCJ long. And then here, anyway, it just goes through all the different adjustments. And then here it was on the 24th. We set this up as trading at 53. Now it's trading at 58. And the spread, we set the spread up. We had a cost. We were in about $1.95. We did some adjustments, make it cheaper. Now it's up to $282, 151% return on that. And so here's CCJ went long here. And then here it was, we were getting out right here and right there. So here was the here it was going out on the 24th. So went from the 21st, 53. We did an adjustment the 22nd. It's trading at 57.45, and now on the 24th it was trading at 58. So we had our spread went from $1.86 we were in at. Now is up. The spread was at 483. So we're up $297 per spread, 159% return. All right. So just wanted to show you, if you do want to add the alerts, that's what you're, kind of a sampling of what you're going to get. And again, make sure today to use Earn 15, and that'll give you that. Let me see, I forgot the EARN, Earn 15, and that will give you, wow, that'll give you the discount. All right, so that's what we got. I hope that was clear to everybody, and I hope to see a bunch of you next week on the Saturday the 5th, 11 to 2, or however long we need, and then we'll finish up Monday the 7th at 4 p.m. to 5, and we'll do a Q&A the next day, so you have plenty of time to ask questions and go from there. So I just want to say